Baby, you should know that, know that. Baby, you should know that, know that, know that. Baby, you should know that, know that, know that. Baby, you should know that, know that, know that. Baby, you should know that, know that, know that.
Hi there, amazing learners. Welcome back to Get It Right with Shola, a place where curiosity meets knowledge. I am Shola, and today we'll be diving deep into a new series on navigating tax season. This is a guide to planning and preparing for your income tax filing. Today's topic will be on understanding income tax basics. Before we get started, if you're new to my channel, welcome. I'm thrilled you stopped by. If you like my content, don't forget to hit the subscribe button and ring the notification bell so you do not miss out on any exciting lessons. To my returning viewers, a huge shout out. Your support means the world to me. Now let's jump right into our topic for today, understanding income tax basics. Whether you're a seasoned pro or you're just getting started, there's something here for everyone. So grab a notebook, grab your pen, and let's get started. Embarking on your first tax season can be overwhelming. The comprehensive guide in this series will provide you with essential information and tips to navigate the process with confidence and with ease. Today, we'll be learning the basics of income tax at a level that is simple for everybody to understand. I have created this slide to help those visual learners understand the purpose of income tax. Taxes are mandatory contribution levied by the government on income individuals or businesses within their jurisdiction generates. The government entity could be local, regional, or national, which are the city, state, or federal government. Income taxes are a source of revenue for the government. The government uses the revenue generated from taxes to fund public services such as education, health, defense, or build infrastructures and fund government programs. By law, taxpayers are required to file their income tax annually in order to determine their tax obligations. In the United States of America, the income tax filing is a way for the government to collect money from individuals and businesses based on their earnings. Here's a simple explanation of how it works. Throughout the year, individuals receive income through various sources. This income could either be earned or unearned income. Earned income is money received as compensation for work or services you provided. Such income includes wages, salaries, bonuses, commissions, tips, and net earning from self-employment. It is the result of your active involvement in a job or in a business. Unearned income, also known as passive income, is money received with minimal effort or active involvement on your part. Unlike earned income, which is directly tied to your time and labor, passive income is generated from assets or activities that requires relatively little ongoing effort once set up. Such income includes dividend and interest from investment, capital gain, rental income, royalties, just to name a few. Now let's move on to filing status. In the United States, there are several tax filing statuses that individuals can choose when filing their federal income tax return. The filing status you select affects your tax rate, deductions, and credits. Here are the main tax filing statuses. The first one is single. You can choose the single filing status if you are not married or if you are divorced or legally separated as of the last day of the tax year. The second tax status is married filing jointly. This status is for couples who are legally married and want to combine their income and deduction on a single tax return. Both spouses are jointly responsible for the entire tax liability, with some exception. The third filing status is married filing separately. Couples who are married can choose to file their taxes separately. In this case, each spouse reports their own incomes, deductions, and credits. However, this filing status may result in a higher tax liability for some couples. The fourth filing status is the head of household. To qualify for the head of household status, you must be unmarried, pay more than half the cost of living for your home, and a qualifying person, such as a child or a relative. And the qualifying person must meet certain relationship, age, and residency requirements. The fifth filing status is qualifying widow or widower with dependent child. If your spouse passed away in the previous 2 tax years, you may be eligible for the qualifying widow or widower with dependent child status. This filing status allows you to use the same tax rate and bracket as married individuals filing jointly. Now let's move on to taxable income. Taxable income is the portion of your total income that is subject to tax by federal, state, and sometimes local governments. Taxable income is calculated by subtracting eligible deductions and exemptions from the total income. Deductions can be standard deduction or itemized deduction. I will make a separate video to further explain tax deduction and exemptions and ways you can maximize your tax refunds. Let's move to tax brackets. The US has a progressive tax system with different tax brackets. As your income increases, you move into a higher tax bracket and the corresponding tax rate increases. It is important to note that tax rates can change due to legislative updates, so it's essential to check for the most recent information. Let's talk about tax credits. Taxpayers may qualify for various tax credits, which directly reduces the amount of taxes owed. Common tax credits include the child tax credit and income tax credits and education-related credits. Let's talk about withholdings and payments. Many individuals have taxes withheld from their paycheck by their employer throughout the year. This helps distribute the tax burden and prevent a large tax bill at the end of the year. Additionally, some people make quarterly estimated taxes, particularly if they're self-employed. Now, let's look at filing a tax return. Taxpayers must file a tax return annually, typically by the 15th of April following the end of the tax year. A tax year runs same as a calendar year from January to December. Taxpayers report their income, deductions, and credits on their tax return. The tax return calculates the final amount owed or refunded. Let's look at refunds and payments. If the total taxes paid through withholding and estimated payments exceed the actual tax liability, the taxpayer receives a refund. If it's not enough taxes that was paid, the taxpayer must make an additional payment. It is important to note that while there is a deadline for filing taxes, there is generally no time limit on claiming a tax refund. If you are due a refund, you can typically file your tax return within 3 years of the original deadline to claim it. However, after this 3-year period, the IRS can keep your refund. The IRS is the Internal Revenue Services. State and local income taxes. Most U.S. states also levy personal income taxes, but 8 states do not impose personal income taxes on residents. The states include Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. New Hampshire also has no state tax on income, but residents must pay a 5% tax on dividend and interest at the end. The state passed a bill in 2008 that will phase out the state 5% tax on dividend and interest on January 1st, and this will make the number of states that do not require income tax filing to 9. Please verify the current tax laws in this state or consult with your tax professional for the latest information, as tax policies are subject to change. It's important to know that tax laws can change and there are many nuances and additional details that have not been covered in this simple explanation. Individuals often use tax professionals or software to ensure accurate and compliance filing. Tax returns are filed or submitted electronically to the IRS for federal income. The Internal Service Revenue IRS collects taxes and enforces tax laws in the United States. All right, amazing learners, that wraps up our session for today. I hope you have learned something new or find the information useful. If you have any questions or a thought, please drop them down below. I'd love to hear from you. If you enjoyed today's session, please give it a thumbs up. If you haven't subscribed yet, consider subscribing by hitting the subscribe button and ringing the notification bell so you do not miss any exciting topics in the future. Until next time, stay curious and keep learning.